Hi friends, good evening. Welcome everyone for today's session on chapter C.1. So continuing with our series on UNTP manual, this chapter, the part being the last part C, and in that the first chapter, what should be the environment for updating transferring regimes? Under what environment or circumstances the transfer pricing provisions or transfer pricing should prevail. So let us have our thoughts on that. Before starting, I would like to acknowledge the efforts of Vishwanath and Gracelyn for preparing these presentations. The legends used arm's length price, APA, advanced pricing agreements or arrangements, ATAF, African Tax Administration Forum, CATA, Commonwealth Association of Tax Administrators, CFC, Control Foreign Corporation Rules, CIAT, the American Center of Tax Administration, CREDAF, it's again a Spanish word title, the reflection at exchange this grante, this administration fiscales. GAR, again, General Anti-Avoidance Rule. IOTA, Intra-European Organization of Tax Administration, LVAS, Low Value Adding Services, MAP, Mutual Agreement Procedures, MNE, Multinational Enterprise, OECD, Organization for Economic Cooperation and Development, SGETAR, Study Group on Asian Tax Administration and Research, SME, Small and Medium Enterprise, TP Transparency, UN, United Nations. Schema for the evening overview: extant transfer pricing rules in national tax regimes, specific domestic transfer pricing rules, updating transfer pricing regimes. Firstly, introduction. Generally, transfer pricing has been a matter of concern from late 1960s when international commercial transactions expanded greatly in volume. With the increase in controversy regarding adjustments by tax authorities to transfer prices, taxpayers increasingly seek practical dispute resolution mechanisms to avoid double taxation, such as MAP, APAs, and arbitration proceedings. Domestic transfer pricing legislation worldwide shows some harmonization in basic principles in accordance with the arm's length standard, though its application is not identical and poses complexities across jurisdictions. In this particular session, we'll be focusing on chapter C.1, which talks about or which reviews the legal environment of TP legislation in a global context. Extant transfer pricing rules in national tax regimes. Background and key considerations. Firstly, many countries have introduced specific domestic tax rules to prevent possible tax-based erosions through mispricing or of transactions between related parties. So where there are of the pricing between two associated enterprise or related entities are controlled, and the price is not at the actual market price. That's where there have been regulations or provisions to curb those practices, one such being transfer pricing. Another approach to transfer pricing income allocation is global formulatory apportionment, though it is not that much prevalent at the global level. TP legislations have to be developed in accordance with the need of every country, because there has to be a certain administrative requirement. Also, what is the economy per se for that particular country, and how is the environment of legislation. Those are the important aspects when TP legislations have to be framed. Two different approaches that may be seen in domestic legislation relating to transfer pricing. First is involves allocation of incomes, deductions, credits by tax authority to prevent tax avoidance. Second being foreign affiliated transactions shall be priced for tax purposes as if it had been concluded at arm's length, thereby requiring the taxpayers to transact arm's length principles. So there has to be provisions for intergroup transactions, specifically international transactions, wherein the transactions has to be at arm's length or which should govern the arm's length principles. Domestic rules, UN model and OECD model sets out basic conditions for TP adjustments and corresponding adjustments to prevent double taxation. Generally, countries apply their domestic transfer pricing rules to cross-border transactions, but some countries opt to apply transfer pricing rules also to domestic transactions, where this would be possible, wherein like in single country itself there will be different tax regimes. Say for example, in India we do have section 80IA and section 10AA, which offers exemptions from tax, and there are kind of tax holidays. So in such a scenario where in India itself, if say one unit or one entity has this kind of benefit, and there are transactions of a normal company or a normal unit of that SSC, which which do not enjoy any benefit under 10AA and 80IA, that series. Transactions between such enterprise, such units may be subject to transfer pricing. That's what we have seen under specified domestic transactions in Indian context. Time lag between initiative of legislation and approval by the legislative body should also be considered while framing the transfer pricing rules. With respect to definition of AE and application of arms in principle, it might be beneficial to have international consistency, but each country must design, as I said, there has to be various things or various factors to be considered. Firstly, being the legal and administrative framework, treaty obligations and resources, etc. Country might also introduce safe harbor rules to reduce tax collection and enhanced certainty. Concept of AE, what exactly is AE? One enterprise is said to have control over the other if it could participate indirectly or directly in the management, control, and capital of another enterprise. If this being the case, two both these entities would be regarded as AE. Countries generally apply criteria for determining control, but generally in Indian context as well, control being again the important one, but unfortunately that has not been defined. But if you consider the general parlance, control would eventually mean 50% of shareholding. It may or may not have 50 or above or 50% or above shareholding, but there would be elements of dependence on inputs, financials, or human resources, dependency on sale, dependency of know-how. That's what we have seen in 92A. Even though a person may not control via shareholding, but it may control via providing a know-how, technical know-how, or say a person's sales is dependent on one buyer, or person's manufacturing or enterprises manufacturing is dependent on one another enterprise. So these may be the factors for the purpose of control apart from the shareholding. If these factors are established, then yes, there would be uh, both the enterprise would be regarded as associated enterprise. Other aspects of domestic legislation, the coverage. What exactly is the coverage? TP generally covers all cross-border transactions between A and contract. As I said, there are domestic transfer pricing applicable. Transactions between local branch office and their headquarters may also be regulated by specific legislations. If there are provisions in the domestic context wherein transaction between a branch office and a head office are to be done at arm's length, yes, TP legislations would be applicable. Methods and compliances, types of methods, choice of methods, and availability of method depends on domestic legislation, which is based on the administrative guidance of other subsidiary material instead of tax laws. Ease of administration, documentation, penalties for non-compliance should also be considered while drafting the legal framework. Forms for receiving TP information, that is, what are the various forms for which you can get the information relating to transfer pricing or the transactions which are relevant for transfer pricing. In that, what are the mandatory disclosure or what are the optional disclosure that needs to be properly formulated. Burden of proof, generally burden of proof in case of transfer pricing is lies on the taxpayer. So taxpayer has to confirm that there are no transactions which have been controlled because of the relationship between the two enterprises. So once that is confirmed, or once the assessee or the taxpayer proves this part, then the burden shifts to the tax authorities to confirm that yes, there has been some control in terms of the pricing, and the pricing has affected because of the relationship between the two enterprises. What are the various issues and challenges in domestic TP regulations? First is the presumptive taxation. Say, for example, if there are presumptive tax, so ad hoc taxation being applied by the tax authorities using secret comparables, this may be difficult for the taxpayers. So in order to have or govern the transactions for associated enterprises. Secondly, being the burden of proof, since this involves review of various documents, gathering information on comparable uncontrolled transactions and market becomes a difficult exercise with passage of time. Countries should keep in mind the interests of revenue and taxpayers. So there has to be a thin line of difference between, I would say, when you are asking or when you are keeping the burden of proof on taxpayer, and also kind of, I would not say harassing, but yes, exploiting the taxpayer in terms of getting the details. There has to be a thin line of difference, balance to be struck between statute and subsidiary regulations. This essentially means recognizing the arm's length principle and the basic applicable to TP through the primary legislation, Objective statutory provisions tend to provide greater certainty because they are binding on taxpayers and tax administrations. Specific domestic transfer pricing rules. Safe harbor rules, as everyone knows, safe harbor rules meaning there are stipulated percentage of margins or transactions pertaining to specific nature, wherein like safe harbor. So once you achieve that, or once you are offering that, there may not be any inquiry further from the department. So say for example, in Indian context, software development services, not getting into the basics specifics, but say software development services, 17% is what the profit margin is expected. So if you achieve that and you opt for safe harbor, surely there won't be any inquiries being asked from the department. So this way the taxpayer can confirm their tax position without any further litigation. Safe harbor practical issues. What are the practical issues? Firstly, it says about 5% markup on cost in terms of low value added services. One of the transactions of low value added services, when it says safe harbor margin to be at 5% markup on cost. So if at all someone has to have or opt for safe harbor, they should have 5% markup on cost. This may not be possible because here we're talking about low value added services, and 5% of markup may not be feasible for the enterprise who are providing that kind of services. For all other transactions exceeding the safe harbor, taxpayers could be required to comply with all transfer pricing rules, and the burden of proof remains with the taxpayer. The safe harbor regime may include provisions and regulations of the procedure for applying for MAP. As an option for the safe harbor, the authorities may also allow taxpayers to apply for APAs to comply with the transfer pricing regime. So these are practical considerations when it comes to safe harbor. Another concept of downward adjustment. Downward adjustment, generally TP provisions would result in increasing the amount of tax payable, but in there is a concept of downward adjustment, that wherein like there is a scenario where there is unintentional over reporting of income. There would be some adjustment done to reduce the income, and that adjustment would be from the department's end and not from the AE's end, to reduce the income and accordingly reduce the tax payment. This is not prevalent in India, but there are countries like Republic of Korea and South Africa which are providing for provisions of downward adjustments. APAs, as in safe harbor, we saw if you're opting for safe harbor and providing specified margins for specific transaction, then there won't be any inquiries or further assessments from departments. And likewise, APAs, you enter into an agreement with the taxpayer, with the authority. The taxpayer enters into an agreement with the authorities to confirm the transfer price, and they get the ruling of the tax authorities that yes, whatever transactions they are showing, the percentage of profit or margin they are showing, that will hold good, or against that margin being offered, there won't be any litigation in future. So the taxpayer enters into an agreement or arrangement with the authorities. As we see in the Indian context, you can go for 5 years, future years, and also for 4 rollback also is possible in case of Indian context. Interaction of transfer pricing provisions with other cross-border rules like CFC, thin capitalization, GAR. CFC rules are designed to prevent tax being deferred or avoided by taxpayer using foreign corporation. Without CFC rules, income would be left at low tax jurisdiction and would not be taxed domestically. CFC rules treat this income as if it had been repatriated and taxes it. Thin capitalization, on the other hand, prevent excessive deduction on account of interest payments. Abusing non-arm's length transaction may come within the scope of GAR. So when you are seeking for transfer pricing provisions, these rules also needs to be considered while formulating transfer pricing provisions, because it certainly has link with the transfer pricing. Updating transfer pricing regimes, gathering information. Countries should keep abreast of developments, exchange peer experience, and keep their transfer pricing regimes updated. Keep up to date with the developments in the international. So in international parlance, like say CREDAF, IOTA, CIAT, ATAF, what are the developments which are happening? Again, what are the news from world organizations like United Nations, OECD, World Bank, IMF? What are the documents which they are formulating or publishing for the purpose of transfer pricing? Creating a clear house for information and capacity development with like-minded countries participate in the South-South dialogue for capacity development and knowledge sharing platform, wherein like even there can be chances given to experts or say people across the world or even in India as well, for example, to provide a platform so that ideas can be shared or suggestions can be given. Examples of measures to update transfer pricing regimes. First is the advanced tax rulings. It helps to create an active tax dialogue between taxpayer and the tax administration. It stimulates a greater cooperation to the extent both parties fix an understanding to pay or not to pay certain taxes. Second of the example is establishing an international consultancy body. An independent advisory group could suggest updates, point out controversial issues, suggest action in certain transparency areas, and even audit the country's tax legislation for improvement. So these measures can be useful for a country to update their transfer pricing regimes. So these were some of the thoughts on how the environment or legal environment or a framework should be for developing transfer pricing provision and updating transfer pricing regimes. Any questions would be happy to answer, friends. Thank you, friends. Have a great evening ahead.